As inspired by the financial management principle, dividend decision is where the intersection of the shareholder expectation meet with the corporate realities. Assalamu alaikum warahmatullahi wabarakatuhu. A pleasant day to each and every one of you. We are the groups 3 and 4, and this will be the continuation part of the group 3 rather, the group 3's report entitled Cost of Capital. So in this part, we will be reporting about the dividend decision. So let us now commence this report with the first topic, the convertible bonds, along with its subtopics, vanilla convertible bond and the mandatory convertible bond. So what is or are convertible bonds? So diba from the word itself, convertible, it can be converted into something. So it is a type of debt security. Now when we say debt security, from the word itself, debt, mayroon kang utang. So ito siya, you buy the debt security and may binabayad sa'yo yung company with something in return, usually with interest. So balik tayo dun sa convertible bonds. So with convertible bonds, it's as if it's a regular debt na mayroong interest na binabayad din sa'yo. Pero, the difference here is that investors has the option to convert the bond into a predetermined number of shares within the company as common stocks. So, katulad nga na sinabi ko kanina, convertible bonds, we have the option to convert it into stocks. So, under it, as I have mentioned earlier, meron tayong vanilla convertible bond as well as mandatory convertible bond. As inspired by the financial management principle, dividend decision is where the intersection of the shareholder expectation meet with the corporate realities. Assalamu alaikum warahmatullahi wabarakatuhu. A pleasant day to each and every one of you. We are the groups 3 and 4, and this will be the continuation part of the group 3 rather, the group 3's report entitled Cost of Capital. So in this part, we will be reporting about the dividend decision. So let us now commence this report with the first topic, the convertible bonds, along with its subtopics, vanilla convertible bond and the mandatory convertible bond. So what is or are convertible bonds? So diba from the word itself, convertible, it can be converted into something. So it is a type of debt security. Now when we say debt security, from the word itself, debt, mayroon kang utang. So ito siya, you buy the debt security and may binabayad sa'yo yung company with something in return, usually with interest. So balik tayo dun sa convertible bonds. So with convertible bonds, it's as if it's a regular debt na mayroong interest na binabayad din sa'yo. Pero, the difference here is that investors has the option to convert the bond into a predetermined number of shares within the company as common stocks. So, katulad nga na sinabi ko kanina, convertible bonds, we have the option to convert it into stocks. So, under it, as I have mentioned earlier, meron tayong vanilla convertible bond as well as mandatory convertible bond. So when we say vanilla convertible bond, it is a type of convertible bond that, what do you call this? Yung investor, meron siyang choice whether to convert that bond into stocks or just remain as it is and keep the debt until its maturity date. Unlike the mandatory convertible bond, whereas it is stated, mandatory nga siya. It is required or it is determined na dapat kailangan mong i-convert into stocks. So walang say ang investor dito. So ang mangyayari dito is the bond will be converted into a stock at a specific date regardless of the market price. So when we say market price, the market price kasi is volatile or flexible. it could be na ngayon mababa yung price sa market, but tomorrow mataas yung price naman sa market, and vice versa. So that's what we call the market price. So regardless of market price, basta mayroong specific date, it is mandatory to convert the bonds. Now let us proceed to the topic, convertible preferred stocks. In convertible preferred stocks, it is as if it's the same with the term preferred stocks. Pero ang kaibahan lang nito is nako-convert siya. Tulad lang din siya ng convertible bonds earlier. So ang convertible preferred stocks, you have the option to convert the preferred stocks into common stocks. So what is the difference between preference and common stocks? So basically kasi, ang preferred stocks is meron siyang priority in dividends. Now when we say dividends, ito yung binibigay ng isang company when they have extra profit or they have gained extra profit from their ordinary course of business. Treat it as like something na bonus na mabigay sa'yo ng isang company. That is preferred stocks. So next is meron siyang priority in terms of giving the stocks. So mauuna ka, unlike the common stocks na you need to wait or di kaya kailangan mo pahintayin na available yung company magbigay ng common stocks, ganun siya. So, unlike naman sa common stocks, the preferred stocks has no voting option. Yun na yung parang downsides doon. So, as I have mentioned earlier, ang convertible preferred stocks is just like the preferred stocks. Only this, from the word itself nga, redundant, 'di ba? Convertible siya, nako-convert siya into common stocks if the investor so wishes it. So, meron tayong here important terms. We have the par value, the conversion rate, conversion price, and the conversion premium. Okay, so let us start first with the par value. So, when we say par value, let us think of it as the price tag of the preferred stock. So, for example, it is the base amount that is used to figure out how much dividend payout you'll get. So for example, for one stock, you have a par value of 6 pesos. That is an example. In terms of the conversion ratio naman, this tells you how many common shares you'll get if you swap one preferred share. So for example is you will convert 50 preferred shares. So each one of those preferred shares is equivalent to 5 common shares. Yan yung tinatawag nating conversion ratio. Next is the conversion price. So when we say conversion price, ito naman yung ating cost per share when you switch it to common stock. So for example, every one preferred share has the conversion ratio of 5 common stock. So yung 5 common stock na yun is equivalent to 150 pesos. Yun siya, yun yung cost doon. And last but not the least is the conversion premium. Now when we say conversion premium, this is the extra cost na ating babayaran in order for us to have the privilege to gain that special right in the conversion of the preferred stock into common stock. So it's like sa shipping fee good, diba when we order something online, we have extra costs in shipping that said object or that said thing we have bought in order for it to get to us. So conversion premium is like that. You are paying it on premium para nga magkaroon ka ng privilege to have special rights towards that preferred stock. So when we say vanilla convertible bond, it is a type of convertible bond that what do you call this? Yung investor, meron siyang choice whether to convert that bond into stocks or just remain as it is and keep the debt until its maturity date. Unlike the mandatory convertible bond, where as it is stated, mandatory nga siya. It is required or it is determined na dapat kailangan mong i-convert into stocks. So, walang say ang investor dito. So, ang mangyayari dito is the bond will be converted into a stock at a specific date regardless of the market price. So, when we say market price, the market price kasi is volatile or flexible. It could be na ngayon mababa yung price sa market, but tomorrow mataas yung price naman sa market, and vice versa. So that's what we call the market price. So regardless of market price, basta mayroong specific date, it is mandatory to convert the bonds. Now let us proceed to the topic, convertible preferred stocks. In convertible preferred stocks, it is as if it's the same with the term preferred stocks. Pero, ang kaibahan lang nito is, nako-convert siya. Tulad lang din siya ng convertible bonds earlier. So, ang convertible preferred stocks, you have the option to convert the preferred stocks into common stocks. So, what is the difference between preference and common stocks? So, basically kasi, ang preferred stocks is, meron siyang priority in dividends. Now, when we say dividends, ito yung binibigay ng isang company when they have extra profit or they have gained extra profit from their ordinary course of business. Treat it as like something na bonus na mabigay sa'yo ng isang company. That is preferred stocks. So next is meron siyang priority in terms of giving the stocks. So mauuna ka, unlike the common stocks na you need to wait or di kaya kailangan mo pahintayin na available yung company magbigay ng common stocks, ganun siya. So, unlike naman sa common stocks, the preferred stocks has no voting option. Yun na yung parang downsides doon. So, as I have mentioned earlier, ang convertible preferred stocks is just like the preferred stocks. Only this, from the word itself nga, redundant, diba? Convertible siya. Nako-convert siya into common stocks if the investor so wishes it. So, meron tayong here important terms. We have the par value, the conversion rate, conversion price, and the conversion premium. Okay, so let us start first with the par value. So, when we say par value, let us think of it as the price tag of the preferred stock. So, for example, it is the base amount that is used to figure out how much dividend payout you'll get. So, for example, for one stock, you have a par value of 6 pesos. That is an example. In terms of the conversion ratio naman, this tells you how many common shares you'll get if you swap one preferred share. So, for example, is you will convert 50 preferred shares. So each one of those preferred shares is equivalent to 5 common shares. Yan yung tinatawag nating conversion ratio. Next is the conversion price. So when we say conversion price, ito naman yung ating cost per share when you switch it to common stock. So for example, every one preferred share has the conversion ratio of 5 common stock. So, yung 5 common stock na yun is equivalent to 150 pesos. Yun siya. Yun yung cost doon. And last but not the least is the conversion premium. Now, when we say conversion premium, this is the extra cost na ating babayaran in order for us to have the privilege to gain that special right in the conversion of the preferred stock into common stock. So it's like sa shipping fee good, diba when we order something online, we have extra costs in shipping that said object or that said thing we have bought in order for it to get to us. So conversion premium is like that. You are paying it on premium para nga magkaroon ka ng privilege to have special rights towards that preferred stock.
Good day everyone. My topic is about the stock split, reverse stock split, and the stock share repurchase. So first, let's talk about the stock split. A stock split is when a company divides its existing shares into multiple new shares. So it is a corporate action where a company increases the number of its outstanding shares by issuing more shares to current shareholders. It reduces the per share price, but remember that the company overall market capitalization remains the same. So, the purpose of the stock split is to increase the liquidity of the stock and make it more affordable for individual investors. So, we have the mechanics of a stock split. For the ratio, we have stock split are expressed as a ratio like 2-for-1, 3-for-1, 4-for-1, 5-for-1, and so on. For example, is for 2-for-1 split, every existing share is split into two new shares. While for 3-for-1 split it's split into 3 new shares. The par value naman. The par value of the stock is reduced proportionally. If a stock with a par value of 10 split for 2-for-1, the new par value becomes 5. So if ever yung par value natin naman is 20, then split siya for 4-for-1, then ang new par value naman becomes 5 then. For the shareholder equity, the total shareholder equity remains the same. The split only changes the number of shares in the price per price. Now, let's talk about the reverse stock split. A reverse stock split is when a company reduces its number of outstanding shares, increasing the price of each share proportionally. It also known as the stock consolidation or share rollback. In a reverse stock split, a company exchanges a certain number of existing shares for a single new share. For example, is in a 1-for-5 reverse split, every 5 shares you own become 1 share. The price of the new share is 5 times the old share price. So we have, for example, is imagine you own 1,000 shares of a company trading at 2 per share, totaling of 2,000. So 2,000. If the company does a 1-for-10 reverse split, you end up with 100 shares worth 20 each. Your total investment value remains 2,000 pa rin. Now, for the share stock repurchase. So what is share stock repurchase? A share or stock repurchase, also known as a stock buyback, is when a company uses its available cash to buy its own outstanding shares in the open market. So, for example is, benenta mo yung stock mo or shares mo. Then, after mabenta mo, after naging, parang naging stable na yung company mo, you buy back your shares. So, share stock repurchase also indicates na parang yung company is na financially stable na siya or healthy na siya. Impact on the financial metrics is that earning per share EPS is buyback reduce the number of outstanding shares, increasing the EPS. Return on equity naman is reducing the equity through buyback can increase the return on equity. While in the stock price, ang impact nito is that buyback can put upward pressure on the stock price due to increased demand and scarcity.
For the next topic at hand, we have the cost of capital. So what is cost of capital? Cost of capital can be said as the overall expenses that a company faces when raising the money to fund its operations or its projects. So, di ba ang ating capital could come from either debt, from, for example, loaning a huge sum of money from the bank, or it could come from the investors or mismo sa equity ng isang owner. It's just like in accounting na assets is equals to liabilities plus owner's equity, diba? So, it also represents the minimum return a company must earn from its investments in order to keep its lenders and investors satisfied. So, para ma-satisfy ang ating investors, kailangan ma-reach natin yung minimum return in order for them to further invest in the company. Kasi if alam nila na malulugi yung ating company, hindi na rin talaga mag-invest yung ating mga investors. So it could also mean that the company needs to make at least a certain amount of profit from its projects so that it can pay back from the people who lent money to the company and reward the people who invested in it. So parang masasabi natin in reality is that why would someone invest in the company if alam nila it's a losing game or if alam nila that the company is going bankrupt? So yun yung ma-infer natin from the cost of capital. So cost of capital has these terms. The following terms are cost of debt, cost of preferred shares, cost of equity, weighted average cost of capital, and the marginal cost of capital, which will be tackled later on by the other reporters of the group.
Sources of long-term capital. Most common sources are bonds, preferred stocks, common stocks, and plowed back retained earnings. For the bonds, it is like a loan. The company borrows money from people or institutions and promises to pay it back after many years with interest. For the preferred stocks, these are shares sold to investors that give them fixed dividends like steady income, but usually they don't get voting rights in company decisions. For common stocks, these are the regular shares of a company, and people who buy them become part owners. They may get dividends, but not guaranteed. They also have voting rights in the company. And for the plowed back retained earnings, this means the company uses its own past profits instead of giving all profits as dividends to owners. They plow back the money into the business for growth. So, in short, bonds is a borrowing money with interest, preferred stocks fixed dividend, no voting rights, common stocks ownership, voting rights, and maybe dividends. And for the retained earnings, it's company's own profits saved and reinvested. Let's move to the next slide. Next slide talks about debt financing. Debts or bonds are borrowed funds that must be repaid with interest. So, debt financing means a company borrows money through loans or bonds that it must pay back with interest. It's like when you borrow money from a friend, then you have to return it later, sometimes with extra. So there are 14 bond terminologies, and let me just read and tell you what it is. Number 1, bond. A certificate showing that the company borrowed money and will pay it back with interest. Number 2, indenture of trust. The written agreement between the company and bondholders handled by a trustee, usually a neutral third party. Number 3, basis points. A tiny unit to measure interest rates. Like 1 basis points is equals to 0.01%. For example, if interest goes from 5% to 5.25%, then the basis points is the 25. Number 4, indenture. Another word for the formal contract of the bond. Example, like the bond's rule book. Number 5, short-term bonds. These are the bonds paid back in less than 5 years. And if it's paid back between 5 to 10 years, that is called intermediate term bonds. But if it's after more than 10 years, then we will call it a long-term bonds. So for number 8, legal opinion. a lawyer's statement that the bond is valid and legal. Number 9, par or par value. The face value of the bond, usually 1,000 or 100,000. So, an example is 100,000 bonds par value is 100, which is what the company repays at maturity. Number 10, original issue discount. A bond sold cheaper than its par value. So, for example, for this one is 100,000 bonds par value is sold at 90,000. So, the investor will still get 100,000 at maturity. Number 11, full faith and credit. A guarantee that the issuer will pay back the bond no matter what. So, it is like a trust that you invest. Number 12, coupon. The interest paid regularly on the bond. So, for example, a 6% coupon on a 100,000 bond. So, that is equals to 6,000 interest each year. Number 13, term bond. So, all bonds in the issue mature, are repaid, on the same date. So, for example, a company issues 50 million in bonds and all to be repaid in 2035, 10 years from now. But for the number 14, that's the serial bond, it is parts of the bond mature on different dates. So, for example, on that 50 million bonds that a company issue, the 10 million matures in 2028 and the other 10 million in 2030 and so on. So that's for the debt financing and bond terminology. So, in short, debt financing is like borrowing money with a promise to pay back plus interest, and bonds are the most common way companies do this. Let's move to the next slide. So, the next slide talks about term structure of interest. It says here that the relationship between interest rates or bond yields and different terms or maturities is referred to as the term structure of interest rates. The term structure of interest rates is known as a yield curve when graphed, and it plays an important role in determining the current state of an economy. The term structure of interest rates reflects market participants' expectations about future changes in interest rates as well as their assessment of monetary policy conditions. So, there are actually three primary shapes. It says here upward sloping, flat, and downward sloping. So, for the term structure of interest, it's about how interest rates or bond yields change depends on the time length or maturity of the loan or bond. If you lend money for a short time, then you may get a lower interest. But if you lend money for a longer time, then you may get a higher interest because there's more risk in waiting longer. So, when we draw this relationship on a graph, it's called a yield curve. So, as you can see in this illustration, the one going upward is the upward sloping, that's the normal curve, meaning long-term bonds have higher interest than short-term bonds. Why? Because investors want more reward if their money is locked longer. So, for example, a 1-year bond pays 3%, a 10-year bond pays 6%. So, this usually means that the economy is growing and people expect higher interest rates in the future. So, the second one here is the flat curve, the middle one, as you can see in the flat curve means short-term and long-term bonds have almost the same interest rates. Why? Investors are uncertain if rates will go up or down. Example, A 1-year bond pays 5% and a 10-year bond also pays 5%. This often means that the company is at a turning point, about to speed up or about to slow down. And the third one here is the downward sloping, the inverted curve as you can see. Meaning, short-term bonds pay higher interest than long-term bonds. Why? Investor thinks that the economy might slow down, so they don't want quick interest or returns. Example, a 1-year bond pays 7%, but a 10-year bond pays only 4%. This is often seen as a warning sign of a possible recession. So, in short, if the graph is upward, that's normal, economy is strong. If it's flat, it's uncertain, waiting for changes. But if it's downward, it's a warning that economy may slow down. Let's go to the next slide. The next slide talks about bond purchase agreement. So, for the bond purchase agreement, it is a contract that provides certain clauses that are executed on the date the new bond issues is priced. The terms and conditions of a BPA include terms of the bond, conditions which must be met before the purchase of the bonds by the underwriter, execution and delivery date and place of the bonds. So, yes, when we say it is like, think of it like a deal or a promise that makes sure both sides follow clear rules before the bonds are officially sold. So, it says here, terms of the bonds. This explains the details of the bonds like how much, interest rate, and the maturity. And for the conditions before purchase, these are the requirements that must met before the underwriters buys the bonds. And for the last one, the execution and delivery date and place of the bonds, this states when and where the bonds will officially be delivered to the underwriter. So, in short, a bond purchase agreement or BPA is like a written promise that sets the rules for selling new bonds. It makes sure the issuer, underwriter, and investors are all protected. Let's move to the next slide. The next slide talks about special types of preferred stock. So, preferred stock is a type of ownership in a company that pays dividends like fixed income. But sometimes, companies create special kinds of preferred stocks to fit different needs. Two examples are adjustable rate or floating rate preferred stock, ARPS. This simply means that the dividend payment is not fixed. Instead, it changes or adjusts based on interest rates in the market. Example, if market interest rates go up, the dividends also go up. If rates go down, the dividends go down too. Example, imagine Anna buys ARPS from a bank. At first, she gets 5% dividend. Next year, interest rates rise, so her dividend becomes 6%. This protects her from inflation. Number 2, this is the second types of preferred stock, the payment in kind or PIK preferred stock. The meaning of this is instead of paying dividends in cash, the company can pay the dividend in the form of more shares of stock. Example, Juan owns PIK preferred stock. Instead of giving him 1,000 cash dividends, the company gives him extra shares worth 1,000. This is useful if the company wants to save cash but still rewards investors. So, in short, ARPS, dividends move up or down with market rates, and PIK, dividends paid with extra shares, not cash.
Preferred stock is a special kind of stock that gives more benefits than common stock. The two main benefits are dividends and assets. Dividends are payments to shareholders from the company's profits, and preferred stockholders get them first before common stockholders. Assets are if a company shuts down and sells everything, preferred stockholders get their share before common stockholders. Some advantages of preferred stock are company don't always need to pay the dividends, so they have more flexibility. Preferred stockholders also cannot sue or force the company into bankruptcy if dividends aren't paid. Moreover, their dividends stay the same every year, so it is more predictable. Unlike common stockholders, they don't get the extra. When company stockholders, let's say for example, a company makes unusually high profits. So the common stockholders get the extra, while preferred stockholders don't. For the company, issuing preferred stock is also helpful because it does not reduce the voting power of common stockholders, and it doesn't need collateral, which are something valuable to pledge like in loans or bonds. The cost of preferred stock means how much the company really pays to raise money from it. It is found by dividing the yearly dividend by the stock's price. If there are flotation costs, which are fees or expenses the company pays to issue the stock, these are subtracted from the selling price first because they reduce the actual money the company gets. For example, we have two examples. For example, one, Grant Hill Homes Corporation pays a dividend of 9.80 pesos per share, and its stock price is 110 pesos. So 9.80 pesos per share is divided to 110 pesos, which is the stock price. Then we would get the 8.91% cost of preferred stocks. Then, for example, in this one, we have a flotation cost. Medco sells its stock for 60 pesos, but flotation costs are 3 pesos. So the company really only gets 57 pesos with a dividend of 6 pesos. So we divide 6 divided by 60 minus 3, which would then result to a total of 10.53%. So that is then the cost of preferred stock. This shows flotation costs make the preferred stock more expensive for the company because they reduce the money received.
Okay, so I will continue with our discussion by focusing on two important concepts related to a company's financing, the common stocks and retained earnings. First, let's talk about common stocks. Common stocks represents the ownership interest in a corporation. When you own common stock, you effectively become a part owner of the company. This ownership comes with several important rights. Stockholders can earn dividends, which are periodic payments based on the company's profits. They also have the right to vote for the board of directors who guide the company's major decisions. Inspect company books for transparency and have preemptive rights. Preemptive rights allow current stockholders to buy new shares before they are offered to the public, helping to maintain their ownership percentage. Common stocks come in different types based on their characteristics. For example, blue chip stocks belong to large, stable, and leading companies with a history of dependable performance. Growth stocks are shares in companies expected to increase rapidly in value. Cyclical stocks are sensitive to economic or seasonal changes, performing well in economic expansions but poorly in downturns. Defensive stocks remain stable even during economic recessions. Other categories include value stocks, which are undervalued by the market, income stocks, which provide steady dividends, and speculative stocks, which carry higher risk but potentially higher rewards. Okay, so when a company issues new common stock externally, it faces flotation costs, which are fees paid to underwriters and brokers. To find the cost of new common stock, the formula is cost of new common stock is equal to new dividend per share over price per share minus flotation costs plus growth. This formula adjusts for flotation costs, ensuring the company considers the net proceeds from the issuing of new stock. Okay, so next, let us discuss retained earnings. These are the profits the company keeps instead of distributing to shareholders as dividends. Retained earnings are often reinvested into the company to fund growth or pay off debt. The cost of retained earnings represents the opportunity cost to shareholders. The return they forego by having their earnings reinvested instead of receiving them as dividends. It can be calculated using this formula. Cost of retained earnings is equal to current dividend over market price plus growth rate. Here, the dividend yield plus the expected growth rate gives an estimate of the cost or required return on retained earnings. Overall, understanding the costs and characteristics of common stock and retained earnings helps companies make smarter financing decisions, balancing external and internal funding sources to support their growth and maximize shareholder value. That concludes my part. I will now hand over to the next speaker. Thank you for your attention.
Next, I will be discussing the preferred stocks, or also called as the preference shares. Preferred stocks are equity instruments, just like common stocks, but the key difference is that they carry preferential rights. This means that preferred stockholders are given priority over common stockholders in certain areas. For example, when it comes to dividends, preferred shareholders are paid first before any dividends are given to common shareholders. Also, if company faces liquidation, preferred shareholders have priority in receiving their share of the company's assets. However, unlike common stockholders, preferred stockholders usually do not have regular voting rights. They only gain voting rights in certain limited situations, such as when their dividends are not paid for a certain period. Preferred stocks also have unique features that make them different from common stocks. There are restrictive covenants, accumulation, participation, call feature, and conversion feature. In restrictive covenants, these are conditions placed to protect the interests of the stockholders. For example, a company may restricted from paying dividends to common shareholders unless preferred dividends are fully paid. In cumulation, if the company cannot pay dividends in a certain year, those dividends accumulate and must be paid in the future before common shareholders can receive any dividends. This protects preferred shareholders. Third is the participation. Some preferred stocks allows shareholders to receive not only their fixed dividends but also an additional share profits if the company performs very well. Call feature. The issuing company may buy back or call the preferred shares at a predetermined price. This is beneficial for the company if interest rates go down. Next is the conversion feature. This gives the stockholder the option to convert preferred shares into common shares, which can be advantageous if the company's common stock prices rises. For example, imagine a company issued preferred shares with a 6% dividend. Even if the company struggles, preferred shareholders must receive this dividend before common shareholders. If dividends are missed, they accumulate and the company cannot ignore them. There are advantages and disadvantages. Let's take a look in point of view of the investors. The advantages are it is safer than common stocks because of priority in dividends and assets. Second, it provides fixed income like bonds but still part of equity. Third, it can be converted into common shares if the company grows. In disadvantage for investors, one is it is limited or no voting rights. Second is fixed dividends means less opportunity to earn higher returns compared to common stocks. Third is the callable feature. It may force investors to give up their shares earlier than expected. For the company, Its advantage for the company is that preferred shares do not create a legal obligation like debt, so they provide flexibility in paying dividends. However, the disadvantage is that they can be more expensive than bonds, and issuing too many preferred shares may affect financial balance. Next is the retained earnings breakpoint. It is defined as amount of new capital a company can arise before altering its capital structure. This refers to the maximum amount of new capital a company can raise without changing its capital structure. Beyond this point, the company must raise additional equity, often by issuing new stocks. For example, if a company retained earnings can fund 5 million in projects, once that amount is used up, it will need to issue more shares or borrow money. This can increase costs and change the balance of equity and debt. This concept is important because exceeding the breakpoint usually results in a higher cost of capital. So when exceeded, the company must raise additional equity. It leads to a higher weighted average cost of capital and can affect the overall financial strategy. Finally, let's discuss the weighted average cost of capital, or WACC. WACC represents the overall cost of long-term financing for the firm. It is like company's average interest rate considering both debt and equity. It is also referred to as hurdle rate, target rate, minimum acceptable rate, or minimum ROI. Companies always aim for the optimum WACC, which is the lowest possible cost of capital, because it means they can finance projects more cheaply. On the other hand, marginal WACC is the new cost of capital after changes in the capital structure, such as issuing more preferred stocks or taking on more debt. Example, if a company's WACC is 10%, any new project must generate at least a 10% in return to be considered worthwhile. Otherwise, it will lower the company's value. Now let's summarize. Preferred stocks give investors priority over common stockholders in terms of dividends and assets. They have unique features like accumulation, participation, call, and conversion. They provide advantages such as the steady income, but also disadvantages such as limited voting rights. Retained earnings breakpoint shows the limit of using retained earnings before needing new capital. And finally, WACC represents the average cost of financing, and companies aim for the lowest possible WACC to remain competitive.